Hi everyone, welcome back to my channel. In today's video, we're going to talk about one of the biggest stories in the financial world, the shocking collapse of Silicon Valley Bank, or SVB for short. SVB was the 16th largest bank in the United States, with $209 billion in assets. It was also the premier bank for the tech sector, serving startups and venture-backed firms in Silicon Valley and beyond. It had clients like Airbnb, Stripe, and Coinbase, just to name a few. But on March 10, 2023, SVB was shut down by federal regulators over concerns about its solvency. The bank's failure came as a result of several factors, including its investments losing value and its depositors withdrawing large amounts of money. So what went wrong and who's to blame? Let's find out. The first factor that contributed to SVB's collapse was its investment strategy. The bank invested a large portion of its deposits in long-dated US government bonds, including those backed by mortgages. These were considered safe and stable investments that would generate steady income for the bank. However, these bonds have an inverse relationship with interest rates. When interest rates rise, bond prices fall. And that's exactly what happened in 2023, when the Federal Reserve started to hike rates rapidly to combat inflation. SVB's bond portfolio started to lose significant value as interest rates rose. The bank had to sell some of its bonds at steep losses to meet its liquidity needs. This spooked investors and customers, who became alarmed that the bank was short of capital. The second factor that contributed to SVB's collapse was its deposit base. As the preferred bank for the tech sector, SVB had a lot of deposits from tech companies that used it for their payroll and other business expenses. These deposits were not sticky, meaning they could be withdrawn at any time. As economic conditions soured over the last year, with tech companies particularly affected by regulatory scrutiny and market volatility, many of SVB's customers started drawing on the deposits. SVB didn't have enough cash on hand to meet the demand, and so it had to sell more of its bonds at losses. This triggered a run on the bank, as more customers became worried about their money and tried to withdraw it. It took just 48 hours between the time SVB announced its capital raising plan and its collapse. The third factor that contributed to SVB's collapse was its lack of regulatory oversight. SVB was regulated by the California Department of Financial Protection and Innovation, DFPI, which is a state agency that oversees state-chartered banks. The DFPI failed to monitor SVB's risk management practices and intervene in time to prevent its failure. The agency was understaffed and underfunded, and lacked the expertise and authority to supervise a large and complex bank like SVB. The DFPI also failed to coordinate with other federal regulators, such as the Federal Reserve and the FDIC, which could have provided more support and guidance to SVB. The DFPI has been criticized for being too lenient and cozy with SVB, allowing it to grow too big and too risky without adequate safeguards. So who's to blame for SVB's collapse? Well, there's no simple answer. It was a combination of factors that involved SVB itself, its customers, its regulators, and the broader economic environment. But one thing is clear, SVB's collapse has had serious consequences for the banking system and the economy. It has shaken confidence in other banks, especially those that serve niche markets or have similar investment strategies. It has also disrupted credit flows to many tech companies that relied on SVB for their financing needs. The federal government has stepped in to guarantee customer deposits and prevent further panic. The FDIC has arranged a deal with First Citizens Bank to buy SVB's deposits and loans, as well as certain other assets. The Federal Reserve has also taken steps to improve liquidity and stability in the banking system, such as launching its Bank Term Funding Program, BTFP, which provides low-cost funding to banks that need it. But these measures may not be enough to prevent future banking failures or crises. There are still many challenges and uncertainties facing the banking industry and the economy. That's why it's important for us as consumers and investors to be informed and vigilant about our money and